Capital expenditures are outlays of cash or the equivalents in assets that are more permanent in nature, held longer than a year, such as property, plant, and equipment. They also include expenditures for such intangibles as patents. Basically, they are assets that are expensed over a period of time greater than a year through depreciation or amortization. Capital expenditures are recorded on the cash flow statement under investment operations. For example, buying a new truck for your company is a capital expenditure. The value of the truck will be expensed through depreciation over its life, let's say 6 years. But the fuel used in the truck is current expense with the full price deducted from income during the current year. When it comes to making capital expenditures, not all companies are created equal. Many companies must make huge capital expenditures just to stay in business. If capital expenditures remain high over a number of years, they can start to have deep impact on earnings. As a rule, a company with durable competitive advantage uses a smaller portion of its earnings for capital expenditures for continuing operations that do those without a competitive advantage. Let's have a look at a couple of examples now. Coca-Cola, a long-time Warren's favorite, over the last 10 years earned a total of $20.21 per share, while using only $4 per share or 19% of its total earnings for capital expenditures for the same period. Moody's, a company Warren has identified as having a competitive advantage, earned $14.24 a share over the last 10 years, while using just the small amount of 84 cents a share or 5% of its total earnings for capital expenditure. Let's compare Coke and Moody's with General Motors, which over the last 10 years earned a total of $31.64 a share after subtracting losses, while burning through a whopping $140.42 a share in capital expenditures. Or the tire maker Goodyear, which over the last 10 years earned a total of $3.67 a share after subtracting losses and had total capital expenditures of $34.88 a share. If General Motors used 444% more for capital expenditures than it earned and Goodyear used 950%, where did that all extra money come from? It came from bank loans and from selling tons of new debt to the public. Such actions add more debt to these companies' balance sheet, which increases the amount of money they spend on interest payments, which is never a good thing. Both Coke and Moody's, however, have enough excess income to have stock buybacks programs that reduce the numbers of shares outstanding, while at the same time either reducing long-term debt or keeping it low. Both actions are big positives to Warren and both helped him identify Coca-Cola and Moody's businesses with a durable competitive advantage working in their favor. When we look at capital expenditure in relation to net earnings, we simply add up a company's total capital expenditure for a 10-year period and compare the figure with the company's total net earnings for the same 10-year period. The reason we look at a 10-year period is that it gives us a really good long-term perspective as to what is going on with the business. Historically, durable competitive advantage companies used a far smaller percentage of their net income for capital expenditures. For instance, Wrigley annually uses approximately 49% of net earnings for capital expenditures. Altria uses around 20%, Procter & Gamble 28%, PepsiCo 36%, American Express 23%, Coca-Cola 19%, and Moody's 5%. If a company is historically using 50% or less of its annual net earnings for capital expenditures, it is a good place to look for durable competitive advantage. If it is consistently using less than 25% of its net earnings for capital expenditures, that scenario occurs more than likely because the company has a durable competitive advantage working in its favor. And having a durable competitive advantage working in your favor is what it is all about. If you would like to watch more of my videos, please consider subscribing to my channel. Take care and see you next time.